How's it going, everyone? It's Sam. Today we're taking a look at index funds versus mutual funds versus individual stocks. We're going to cover it because early on in your investing career, it's really hard to know what you want to invest in, what you should invest in. I know a long time ago, people really just invested in mutual funds and individual stocks. There really were no indexes, and then they became really popular over the last 10 years or so. So we're going to look at all of these different comparisons. We're going to go over some of the pros, some of the cons of each of them. And, just before we even get started, I'm not a financial advisor. I'm not a stock analyst, but I do own individual stocks and I own index funds. I don't really hold many mutual funds, but I'm going to go over that. I do own a little bit, but we'll talk about that. We'll talk about the pros and cons, and I'll let you form your own decision at the end for what is best for you. So before we get started, if you don't mind doing two things for me, please hit the like button. It really means a lot. Also, let me know kind of what you're invested in too in the comments below. And then if you want to support in another way, there are links to a couple different stock brokerages down below. So if you do want to start investing or you just want to support the channel, there's a link to M1 Finance down there. They're my favorite long-term brokerage. They're really based around helping you grow your wealth, and they have some really good features that I've talked about in a video before, and I'll link that here if you want to check it out. But I really like them. Also, there's WeBull up there too, where you can get a free stock worth up to $1,650 if you deposit $100 or more. So thank you guys. We'll get right into it here. So first of all, we're going to start with index funds. So index funds are kind of a new way of investing that have come around really since Vanguard. If you've ever heard about Vanguard, they were started a while ago, and they were really the pioneers for index funds. And what index funds are is they are a basket of stocks that you can hold where you don't have to invest in all the individual stocks. It's just one giant basket of stocks that tracks something. So for example, VTSAX or VTSAX is from Vanguard, and they're a total stock market index fund. You can also get an S&P 500 index fund, which holds 500 of the largest companies in the US. There are a couple different ways that you can do it, but we're going to take a look at VTSAX specifically. It's a really good way of diversification. So just going through the list here, and this is by no means an all-inclusive list, but I think it's a pretty good representation of the pros and cons. So first of all, they're really easy to understand. This is a really nice way of investing because you know that you're basically buying an index. You're basically buying the US economy. If you're buying the S&P 500, if the economy goes up, it goes up because companies are making money. If the US economy goes down or the stock market goes down, it's probably going down too. They're also very low cost. So this is something that a lot of people don't really realize at first, but expense ratios, or what these different companies charge you, can really decrease how much money you have in 30, 40 years. So for example, VTSAX, they only charge 0.04%. So if you have $100, you're paying 4 cents a year to be invested with them. So that's awesome. They also have really good diversification, and I haven't put this on here, but you're invested, if you're in an S&P 500 index fund, in 500 giant, really well-known companies. So they are companies that are billions of dollars. They are companies that have thousands or tens of thousands of employees that are working to make them profitable. So that's another great aspect of having an index fund. The thing that I really like about it is it takes psychology out of it. So if you're not someone that's invested for a long time, or you haven't read a lot or listened to a lot on investing, a lot of the time your own psychology can get to you. So for example, around March this year, we saw a massive dip in the market. If you were someone that decided that you wanted to pull your money out because you saw the money going down and you were worried about the stock market, and you pulled your money out when it was at the bottom and then it was too late to buy back in, you have missed out on a lot of gains. So with the total stock market index fund, you know that it's going to return. So after every dip, it goes back up. So it's not like an individual company where you have to worry, is this company actually viable? Are they going to be able to return to where they were before? With the S&P 500 index or with VTSAX, you just put your money in and you don't touch it until you need it again. You never try to move it in and out for the most part. You just keep it in there and you know that it will get back to where it was and continue to rise over time. This is just over the last 5 years, but if we look at the long-term chart, It's the same thing. So even around 2008, it went down, but then it went up just a few years later. So those are some of the pros of the index fund, along with the fact that it takes little to no time and effort. So after you start investing in this, you just throw money at it. You don't have to try to pick stocks. You don't have to do research. You just throw money in there and you know that eventually it will return you a good amount of money. So you can kind of expect a 7 to 10% return with this. Some years it's about 20, 30%, and then some years it's negative. So overall, though, it averages to about 7 to 10% return over the last 100 years. Now, another way of investing is to use individual stocks. This is something where a lot of people have been interested in this. This is probably the oldest way of investing, and this is just by buying individual companies. So if you've heard of Tesla, you could buy Tesla shares if you have a brokerage account. Now, there are many pros and many cons to this, but I'm going to keep it pretty short here. So there's more potential for growth. So if you invest in an index fund, you probably won't get 100% returns in a year. But if you invest in an individual stock, you can definitely get 100% returns or even more. So for example, if you invested in Tesla stock a year ago, you would have invested at $45. Now it's worth almost 10 times that. So it's worth about $450 a share. So if you had the foresight to put in $100, you would have $1,000. If you had put in $10,000, you'd have $100,000, etc. So you could definitely make a lot more money, but there also is some risk. So for example, if you've heard of Microsoft, they've done really well over the last couple of years in their stock price. However, if you had invested in them around 2000, let's say, and you had bought in around $57 a share, you could have waited 10 years and see your investment get cut in half. So there's definitely some more risk with individual stocks. You have to do your research. You have to be very well read. You have to have a strong stomach. So when a stock goes down, you have to stick with what you think. So you can't just always go with what everyone else is doing. That is a recipe for disaster sometimes. But there are also some other great benefits of individual stocks. It's the lowest cost. So if you invest and you use a brokerage that has free trades like M1 Finance or like WeBull, you don't have to pay anything. In the index fund, you still have to pay 0.04%. So this is really the lowest cost if you're able to do it successfully. Now, you're also not investing in dying industries. So for example, with index funds, you're investing in whatever they have in that index fund. So even if you don't agree with it, or even if the industry is in decline, if it's still included, you're still investing in it. For example, I kind of think of the oil industry, and you might not think this, but I kind of think of it as a dying industry over time. A lot of companies are going to electric versions of power. A lot of companies are looking for more cost-efficient ways of doing business, and oil just isn't very cost-effective. It's also bad for the environment, and this is something that I see over the next 10, 20, 30 years, maybe not going away completely, but definitely on the decline. But if you invest in an index fund, you're probably invested some way in oil. But if you invest in individual stocks, you don't have to expose yourself to that kind of industry. Another thing is you can focus on specific strategies. So for example, if you want to invest in dividends, you can invest in dividends. If you want to invest in high growth, you can invest in high growth. You can get that a little bit in different index funds, but if you're using a general stock market index, you're getting so many different companies that it's really hard to dial in on a specific strategy. Now, the other thing I think that is very undervalued is that this is very interesting to invest in individual stocks. So if you're good at it, it's really interesting. It can be just fun in general. And then also, I think if you enjoy something, you generally do really well at it. So if you really enjoy investing, you're probably putting in a lot of time, and then you're probably going to do well at it. If you don't find index fund investing interesting, and maybe you just become demotivated, then it might be hard for you to invest. If you don't find it interesting, maybe you don't put in as much money. So that's something to consider too. Now with individual stocks, I would definitely want to say too that there is a lot more risk. So like I said earlier, you can invest in a stock and have it go down 50% the next day. You can invest in a stock and maybe it goes down 10% and then it goes down 10% and then goes down 10%. It goes up 10%. It can go down 50%. Maybe you sell it then and then it goes up 200%. Who knows? It's very risky compared to index fund investing, but with this, you can expect returns anywhere from negative returns up to over 100%. So this is something where I know people that have averaged 20% returns over time. It's very difficult, but it can be done. The other way of investing is mutual funds. So this is something that a lot of people don't really understand. This is essentially a company that you pay to invest in, and then they invest in a specific manner. They invest in certain companies and they charge you for their expertise. So they can definitely outperform the market. So for example, if you look at ARK Invest, or if you've heard of ARK Invest, they are kind of a leader. A lot of people are talking about them now. They have been able to do really well this year. For example, a year ago, they're at $43 a share. Now they've gone up 124% in 1 year. Compare that to the S&P 500, or just the index fund, the total market stock index fund. The total market has been up 21%. So obviously ARK has severely outperformed the general market. Now with this though, you have to pay a little extra. A lot of the time they might charge from maybe 0.01% all the way up to 1%, even 2% I've seen even more than that. It can definitely be more expensive to invest in these, and that really erodes your returns over time. So I would stick with something that's very low expense ratio if you want to do this. Of course, if it's something like ARK Invest and you're willing to pay the extra money, I understand, but over the long term, it's definitely going to hurt your portfolio in a very significant way. So be careful of that. Run the numbers to see really what makes sense, because I don't personally invest in anything that's more than 0.3% expense ratio. The third thing is, this can be very hard to pick. So there are a lot of mutual funds. This is not something where you pick one of 10 different mutual funds and you invest in it. There are thousands of mutual funds. So it can be really hard to pick, just like an individual stock. So you don't know how these mutual funds are going to do over the next year. So you kind of have to do your research and pick whatever you think is going to do best. Now, a lot of these don't outperform the general market or the index funds. So for example, Warren Buffett had a bet, and this is something I find really interesting. He had a bet and he wanted to challenge the hedge fund industry. So hedge funds are kind of like mutual funds, but they have a lot more expertise, and they generally work with very high net worth individuals and work with a lot more money. So they're companies that manage billions of dollars, and they're moving money around like crazy, trying to outperform the general market. So Warren Buffett made a challenge to the hedge fund industry, saying that between the fees, the costs, and the expenses, that they could not hand pick a portfolio of hedge funds and beat the index funds over 10 years. So this was something that he bet $1 million on, and a hedge fund took him up on the bet. Now at the end of the 10 years, Warren Buffett won that bet. And these are companies and these are people that are highly trained, more than the mutual fund industry, and they were not able to beat the general market. Warren Buffett has regularly said that if he had to instruct his family on what to do with his money, if he passed away, he would tell them to stick it in index funds. So this is something that you should consider. Warren Buffett's one of the greatest investors of our time, and I think we should definitely take a second to kind of let that sink in. So let me know your thoughts on this. These are just my thoughts. Again, not a financial advisor or anything like that, but I know that a lot of people have questions on what's the best way to invest, and it really depends on your preference and kind of what you're looking for, what you are willing to accept, how much work you want to do, and a variety of other factors. So thank you guys so much. I really appreciate it. Thank you for hitting that like button and using those links down below. Let me know if you have any questions. I'd love to hear what you're invested in, and I will see you guys in the next video. Bye.